You've been on both sides, the buy side and the sell side. Is this sell side talk or do you buy it?
No, so look on both sides, right? On both sides, I have benefited, and I suspect many people in this panel and in this room have benefited from the myopia. I think that Rhythm beautifully picked up. It's bizarre, actually. I think Rhythm's numbers are bang on. And just to sort of put it in a different way, in India, if you take the 20-year dollar return, Nifty TRI, it's I think 14.2%. It's the second best in the world amongst large markets. But even if we didn't benchmark it, even if we didn't say whether it's second best or third best, if I told you, we told anybody else in the rest of the world that India does 14.2% total return US dollar over 20 years, I think the 10-year number is $8.5 returns. These are very good numbers, right? So on both the buy side and the sell side, I had a relatively easy job on the sell side. I have a relatively easy job on the buy side because we tend to tie ourselves up in knots about the economy, about market kahan ja raha hai, needlessly so. And because we tend to tie ourselves up in knots for no good reason, right? We tend to tie up ourselves in knots for no good reason. We sell good companies, we sell the Indian market. So does the foreign investor. Who also gets caught in this kind of wild frenzy of pessimism that we push ourselves into from time to time. And that creates valuation anomalies. Right? As a broker, I tried to make money from it. It's far easier, actually, to make money from it from an investor. Let me flip it and give you the other side of the coin. The country which has played this game the best of revving up non-stop positive publicity, right? It's the world's most populous country for a few more years, I guess. It's a country whose market compounds dollar terms over 5 years, 10 years, 20 years, 30 years at 5%. That's China. Whether you look at the Hong Kong market or the Chinese mainland market, 5% compounding dollar is all you get. And yet, they've been spectacularly successful in attracting 5x, 6x the FPI money that we've received. They've been spectacularly successful in selling the stock market to their public, right? So it's two sides of the same coin. Our lack of ability to convince our own population, the RBI says 95% of household savings is in physical assets. Our lack of success in persuading our own population, our lack of success in pursuing FIIs is not because we have crap companies or a crap stock market. To the contrary, our companies generate far more cash flow than the Chinese and we compound better. Our lack of success is a public relations failure, and hopefully, courtesy stellar work by folks like Mr. Desai, that PR failure will soon be addressed and the Chinese stock market will end up, China's FPI flows will end up being where they belong, and the sort of the decades-old imbalance will be redressed.
Kenneth, as an old seasoned investor, how much of this is in the price already? All this bullish talk that we're hearing today.
So you have to construct a portfolio, okay? I typically look at it from a perspective that you could get an entire portfolio between 10 times. You have to go for a very different part of the market to actually do that, but it's available. But just to add to to what's already been said, there are a couple of pointers that I'd just like to point out why 2000, this decade is a little different, right? Step back into 2000, 2010, or even before that, and sometime after that, India exported because you needed the dollars. Now, when I just look at it, we've got IT, which is a net exporter. We've got pharma, which is a lowest cost producer and a net exporter. 52% of all pharmaceuticals manufactured in India is exported. We are very large in agrochemicals across the entire world. We are the net exporter of intermediates right now. If you look at automotive, okay, surprisingly, almost 25% of all automobiles produced in India is getting exported to an extent. Then you look at smaller industries like aquaculture, et cetera, that's all there. And all these utilization levels are at between 75% to 80%. So you got spare capacity and you got lowest cost manufacturers in India, including the steel, including metals, which is the steel, which is a large part. Now, this is what's happening on manufacturing. Okay, and I can't quantify this, but if I had to say this, India is 3% of world GDP. We probably be 3.5% of manufacturing capacity, as 3.5% of manufacturing capacity compared to what's there outside the world. Now, this is a debt-free balance sheet, which is where corporate India is. Take 1999 to 2022, India's debt equity at the corporate level is sitting at its lowest that you've ever seen in the BSE 500 companies, and that's, my sense, is around 30% of India's GDP. So that's the asset side. If I flip over to the liability side, you're coming out of a huge bear market in corporate lending. Okay, you tabulate the banking balance sheets, and today an average of 28% of the banking balance sheets or the corporate side, which is essentially PSUs, is sitting in investments, which is the leverage that you got on your financial side. So all we need is demand. We've got capacities, we've got the cost structures in our favor, and if we can get the growth, we can leverage that growth. Frankly, in my investing experience, while India has been an off and on cycle that you've seen, I haven't seen a formation of the cycle ever take place. So markets, headline, expensive, driven by a lot of companies that probably belong to a subset of businesses that got extrapolated over the last couple of years. The opportunity, should demand environment stabilize globally, I think we will feed into the rest of the world and do it very successfully in this cycle.